Well, g'day everyone, it's Liam Garman, co-host of the How I Met My Broker podcast. And today we have a fantastic episode where we will be unpacking how you can supercharge your investment portfolio over 2026. And my co-host Hung and I will be going through some of our key episodes throughout 2025, unpacking those lessons which we took away that can help you expand over the next year. And throughout the episode, we'll also have some key questions from our listeners over the last year, which we will be addressing. So stay tuned for that shortly.
Welcome to How I Met My Broker by Strategic Brokers, where we uncover the stories, strategies, and insights of individuals who've built significant wealth through smart leverage. Get ready to learn, be inspired, and take your property game to the next level.
Well, g'day everyone, it's Liam Garman, co-host of the How I Met My Broker podcast, joined as always by Director of Strategic Brokers, Chuy, my co-host on this amazing podcast. Mate, how was your break?
Hey, it was good, mate. Well-needed time off, that's for sure. We had a blockbuster year last year, which was the biggest year we've ever seen. I think our business grew over 100% year on year in that last 12 months. So everyone was exhausted. Yep. Everyone needed that little bit of, downtime. Got back on the desk for 8 hours yesterday for the first time. Which,
that's painful.
It was absolutely painful. Yeah. I finished that and I had to do my own property transactions. So I spent 3 hours doing that afterwards. So technically an 11-hour day, which was, it was a lot. I crashed out and had an 8-hour sleep after that, which was amazing.
You were telling me before the potty that because, it's barbecue season, right? Everyone's seeing family, friends for Christmas, New Year's, that your leads, your referrals actually went through the roof during the holiday period.
Yeah. So during December, when everyone took time off, obviously shutting down, I was the skeleton. So, they talk about skeleton
you were the
staff.
skeleton
I was the skeleton
yeah.
staff. Yeah. So I was getting all of the leads come in and then I was allocating them and calling brokers who wanted to do a few extra deals throughout Christmas. I didn't want everyone working, but there were certain people put their hands up and we allocated all the deals. But I tend to find that December is quite busy because everyone's at a barbecue talking about, how amazing so-and-so was or whatever happened in their property journey over the last 12 months. And, some of the guys rocking up at barbecues say, I bought 3 houses. And everyone was like, how?
Yeah.
What did you do? And they, they're like, let's get to the source. So the inbox was getting filled from that for sure.
100%. And that ties into what we will be unpacking today, which is we're going to be discussing how people can supercharge their portfolios over 2026. And the way that we're going to do this, Hung, is we're going to go through some of our biggest podcasts this year, taking away the key lessons from each one, how to get in the market, when to move into commercial, what to look at when developing as well. Some of the key takeaways from that. But also we've got a fair few Q&As that have come over the holiday period from some of our listeners that we'll dive into because I think they're questions that a lot of people have. But before we get into that, you mentioned that during that barbecue period, a lot of leads are coming in because, people are asking that very, very fair question of, how did you get 3 property portfolio? It's so astounding for a lot of people. And it goes to the crux of why this podcast is so important. It's about making that team. It's about surrounding yourself with experts. One of which, actually probably the most important, is which broker you choose. And in terms of that, why they go to strategic brokers, pardon the pun, like yourself, rather than, and not to knock them, but, Bob and Jane from the corner, and they specialize in an area with PPORs and they just kind of tick and flick. The benefit of having someone that's done it, that has been on that investment journey themselves, knows how to handhold people throughout the process rather than just getting the first person that comes in on Google. Why is it so important that people need a broker that has done it on their team?
Yeah, I think it's a matter of having somebody who's experienced a bit of everything. And I guess in my team, most of our guys are investors, or pretty much also all of my guys are investors, or they've been through a lot of buying processes for themselves, whether it's a PPOR, whether it's investments. And it kind of flows through for myself. From the very first episode I've done on How I Met My Broker, I explained about all of the mistakes that I made throughout the journey. And I think, mistakes are really important, or learning from people who have made the mistakes, because I won't make the same mistakes again. And nor do I allow our clients walking through the door make any of the mistakes that we did, in a sense. So what we do is we give them as much information as we can to show them, how things or what the options look like, rather than just going, hey, well, I just want a PPOR. Why? What are your repayments? How's that going to affect your lifestyle? How's that going to affect the future of your portfolio? And then are we just buying for the sake of buying? Is the market right for you to be buying? That's something that they have to obviously deep dive, listen to a lot of podcasts, speak to buyers agents, whichever path they go down. What I notice with a lot of, I guess, what we call professionals in the broking, in the accounting and everything, they kind of live by their own trauma. I don't know if that's a thing, but some people, they make mistakes, but they never revive from it, right?
Yeah.
So then they share those mistakes on to their clients. And, I've seen accountants turn people away from buying investment properties because they're like, oh yeah, look, WA has done nothing for 20 years. So I'm like, mate, have you looked at the data the last 3 years? Have you looked at what's happening there? And they're still living off their 20-year legacy or whatever happened back then, that they lost money in a mining town because that's their trauma.
The bias comes through.
The bias comes in massively, right? So that's the thing that I don't like people doing. Like, if we're going to do something, let's give facts and let's figure out what your next move is from there. So which brings us to this potty, which is this. I thought this episode is quite special because we'll reflect. If you haven't listened to the previous episodes, so if you can get tune through them because they add a little bit of value. But I think we could do a very quick summary on each episode and the value or the value add that each episode brings.
Yeah, we'll put them. We'll put links in the show notes. So for anyone joining us for the first time, you can go back and listen to those. But your point's so true. The biases that you hear. And one thing that I always say to everyone, and obviously we don't give financial advice, but I always think it's fair to your point, do your research. Go out, look for a broker that has gone on that journey, that has your best interest. Brokers at the end of the day, it's a commission-based industry, right? The fact that you're willing to speak to your clients and say, oh, are you sure you want to make that purchase? Shows that you're not just ticking and flicking. You're not just trying to get a new round of commission. You want actually your client to be successful, because at the core of a good broking business is you want your client to be so successful that they're 10-time repeat customers. That's where the lifetime value comes through. You don't want them to be burnt out after the first one and never come back.
Oh, 100%. I think our philosophy is around looking after people and genuinely treating them like family. So that the idea is that when people come into our business, we never lose them as clients. They're with us for life, which is part of, I guess, the fact that we are somewhat a family business. Friends and family are all working in the business. So we just live and breathe that culture. It keeps running forever, really.
Now, we're going to dive into the first 4 episodes of the show. And to kick us off, episode 1, Hung, you and I had a conversation about your investing journey, your journey to becoming a broker, which ties into what we were talking about before, that everyone has those perceptions of their past. Take us through, what are some of the key lessons from your journey in that episode 1 that investors should be taking away to supercharge their portfolios over the next year?
Yeah, so I'm very open and honest about making mistakes in the early run. It's all about the opportunity costs. I bought a whole bunch of off-the-plan properties.
That's right.
Yeah, so, which I held on for too long, right? So if I had my time back, I would have sold them much earlier and put them into much better assets, which would allowed me to get into further assets. So I think the ability to identify that is really important. And the ability for us to identify that as the customer's going through the purchase, not telling them yes or no to a transaction, but just stating the facts, right? Whether you're buying a property with 4,000 units in the complex or you're going to buy a boutique block with 4 with a massive parcel of land, very, very big differences between the two, right? And especially when it comes to time to sell. And sometimes people complicate property. I think they think too hard about, all the bells and whistles. You really just got to look at what the supply and demand is for that and what the actual intrinsic value is of the property sometimes. And that, when you're just comparing apples with bananas, and then you're not getting the right result. So I think it's one thing to make mistakes. I think it's another thing to own up to the mistakes and share that knowledge with people. So so a really good team. People who have experienced a lot of hardship or different things in their property journey that they can share with you and show you what actually works. I think it's super helpful for any listeners out there.
And it's easier said than done. And I'm going to ask you something personally. This is probably something that a lot of our listeners would have grappled with or are grappling with. I'm going through it at the moment as well. The right time to sell. what if, you're in that position and like I said, I'm going through at the moment, you're kind of 50-50, you've got this asset that you don't expect is going to go up. There are better markets you can go into. Actually, and to be honest, there are overlooked transaction costs. You've got the selling fees, you've got conveyancer fees, you've got on both sides, you've got stamp duty when you first purchase it, but then when you move your capital onto the next investment property, you have that stamp duty as well. Is it just one of those cases you just have to rip the Band-Aid off sometimes and maybe take less of a gain than you hoped?
Yeah, so I think it's a hard one with obviously putting that to the broad market. Everyone's circumstances are a little bit different, right? Because you might be able to sell one but keep a debt facility, for instance, which will allow you for a deposit, this thing I think called a portability, which I do a lot with clients.
Can you explain that?
Yeah, so let's say you've got a house that's worth $1 million and you've only owed 200 grand on it, and you've got an investment property that's worth 500 grand and you've got a 400 grand debt facility, right? And they're both at the same bank. You could retire that 400 grand debt facility, for instance, into your major lender. And then you sold it for, say, whatever it is, 500. The proceeds of that 500, you get the whole proceeds. And then you can use that towards, I guess, other lenders or other banks who will give you more borrowing capacity to then spread it amongst multiple assets, for instance. So you can be quite creative. So I'm saying not everyone's got the same circumstances, but something like that I've done for many clients in the past. More aggressive clients who want to buy multiple properties because they see the writing on the wall and where they're buying and the areas that they're targeting. And obviously they're working very close with VAs, which are buying the right markets. So so I think there's no fixed and fast formula. I think it's having a strategic broker who understands, I guess, the game in the sense of, well, are you selling for the sake of selling and trying to work out, is it going to be worth more in 3 years? I think the key is selling and then moving that money very quickly.
Yes.
Yeah, it has to be a simultaneous thing. Because if you just leave it there, it's going to make money at some point. Property is very forgiving, right? It's all about making the maximum out of what you have, and the opportunity cost by not selling. You might be chewing up your borrowing capacity. The property is chewing down your cash flow because you might have bought a unit with a cinema complex or something in it that's $3.5 grand a quarter strata.
Yeah,
I think ripping off that Band-Aid, knowing that there's a better market, and then obviously putting that into a spreadsheet or into a calculator will obviously help you looking at the forecast of growth. You're not going to get that right, obviously, but if you can just look at like maybe 2% growth versus 7% growth on leverage money, it starts making mathematical sense pretty quickly.
And that ties into something that we'll be talking about later, which is rent vesting strategies, which I know has become vogue over the last few years. But moving on to episode 2, you had someone who you've been working so closely with for many years. I think you even knew each other growing up with Chuy.
So we've been best mates since we were like 14, 13. So over 25 years of friendship, which is amazing because we've seen the journey together, which it was a fun episode to have as an opening one.
And you guys actually shared a lot of the same, not mistakes, but were some of those learning points in your investing journey that you touched on. So talk to us, episode 2 with Tuan. What were some of the key takeaways from that? In particular, I think it was, looking for those opportunities to get into a growth market. Yeah,
so I think the interesting part or key highlight with Tuan is fortunately we've all our friends, we've all kind of come together, went into professional networks. But I think core to all of that is the ability that he can just pick up the phone because we have that relationship and just run scenarios by me. And I think we did mention on that potty how many times he calls me every month to run different deals that he wants to do because he's got a shopping problem, this guy. He just wants to go and buy stuff all the time, right? And good on him because he has the ability to, but we kind of a ability to bounce off each other. So not just purely your professional network, but looking at your friendships. So if you're sitting around with a bunch of guys who have that tall poppy syndrome trying to cut you down when you're looking at property, you've got to actually look at yourself and your friends and go, are these the people I want to be around, right?
Yeah.
The friendship circle will kind of influence your decision making as such. And then simultaneous to that is then obviously the professional network. You need people you can bounce off at the same time without obviously bothering them too much, but you need that kind of synergy of friendships and both professional relationships. So that will allow you to probably accelerate much faster once you're surrounded by that energy. So that's a key point around Tuan and how his journey unfolded over the years. But he had a special thing about him was that he always bought for necessity, in the sense of he made most of his money through owner occupiers, which I know sounds strange, but the reason why it kind of worked was that every time he wanted to buy an owner occupier, I always flipped the scenario on him and go, well, what's your worst case? If you were to rent this property out, what would you get? And every single time it made sense as an investment, up until we got to the final house, which is that's when it's like, well, if you rent this out now, you're going to lose a lot of money every year. It doesn't make sense. But between all the commercial properties and the resi stuff, everything made money, but it was also a good time in the market. And whenever it was a bad time in the market, I'd draw the numbers for him, and he'd be like, okay, no, that doesn't make sense. So yeah, look, as we were saying, there was the rent vesting versus buying owner occupier. Depends which market you're in, So if you're in a market where you really can't see, there's no writing on the wall for the property market to go up in the next 3, 4, 5, 6, 7 years, wouldn't you want to put your money elsewhere that's going to make you money? And could you not just rent in that area and save yourself a lot of cash flow, which will allow you to build out a substantial portfolio? So it's a hard one, but you really have to do the numbers.
And I think even with the commercial with Tuan, the interesting thing about that was even with the commercial properties he used his business in them. And he did the same strategy with that. Though the idea of jumping from owner occupier to owner occupier doesn't always necessarily work. And perhaps if you're in some of the big cities now, that might not be the most successful strategy. Again, it goes to a time and place. It depends where you are and where the market cycle is.
Yeah, 100%. And it might not be the most efficient, but property is very forgiving. So in prime markets, even if you make a mistake, they tend to fix themselves over time. But how long do you want to wait? And could you put your money elsewhere to get you a much better result or outcome?
Is there, in that particular scenario with Tuan, one thing that we did discuss was the ability to take advantage of things that can help you enter into a market, guarantees, even some interesting cultural things like working with the community, I think is a good way of putting it.
Yeah, so maybe this one's for the first home buyers out there, because we did mention that we're going to talk about supercharging it for them. But, I think with today's, there's so many different options to get into the first, to your first property right now. I was just looking at the 2% scheme, which I thought was pretty interesting.
Yeah, the shared equity scheme.
Yeah, so the shared equity scheme was, I thought that you would have to pay the government rent for 30% of the property, but you don't.
No.
Which is amazing, right?
Yeah.
I was actually looking and going, it's actually a good deal. But there's obviously an income cap, there's $100,000. So things like that, you're quite limited on, but those who can get in, great opportunity, right? So don't do it like me and Twine, where you have to go beg and choose for money from, from family members. I don't know if you listen back to the episode, this thing called Hoi in the Asian community, which basically everyone puts money into a kitty and then you borrow the money at nominated interest rate. Sometimes somebody takes the money and runs with it, but for this purpose,
they're not.
They're not. They're going to buy a property with it. So, no, but if you can, the sooner you can get into your first property, the better. But obviously, learn as much as you can. Don't just buy whatever.
And this comes back to what we were talking about before, where it's, you've got the 5% deposit scheme, you've got the shared equity scheme. There are very simple ways that a first home buyer can get into the market, but exactly what you're saying before, do the basics, do the basic financial analysis of whether this asset is right for you or whether it's not. And there are plenty of examples, if we take units, as an example, there have been plenty of places in Brisbane and growth markets like that where you've bought off the plan units and they've gone up 20, 30% in a year because just there is not much stock going online. On the flip side, there are places in Brisbane which are kind of stagnating. I'm just picking that as one growth market because there is such an oversupply. If we look at Parramatta, just as a bit of fun, go on realestate.com.au and look at some of the unit prices in Parramatta and look at when they were last sold, because there are plenty of properties there when it was last sold in 2015. It hasn't budged at all over.
It's not gone backwards,
and
right?
some of them have gone backwards over 10 years. So you have to do the basic financial analysis because, and I think this is very fair to say to a lot of our listeners or to people who are listening and they've got kids or cousins or little brothers, little sisters that are looking to buy their first property, you also have the risk of, and I think it's something that a lot of people don't talk about, which they should, is the risk of going into negative equity when you've only put down 5%, because there were a lot of headlines. This is our first podcast of 2026. There are a lot of headlines with some banks forecasting interest rate rises. I think NAB's forecast an interest rate rise in Feb and in May. and a lot of people predicting that markets like Sydney might actually start tapering down a bit. It might lose a little bit of heat. So if you've potentially bought into these oversupplied markets and the market does cool down a little bit in, say, a major metropolitan area like Sydney, and you do have to sell your apartment for whatever reason, your partner goes on maternity leave or paternity leave, or you're made redundant, and there are these life decisions that come and force you to sell, you can be at risk of actually still owing the bank money even after you sell, because you have to factor in the selling commission on the other side, like we spoke about before. So do your basic financial analysis. Is this a good investment? Even as a PPOR, could I potentially lose money on my PPOR? And speak to your broker, speak to your A-team about this.
100%. Look, you really need to understand what you're doing. And I think getting as much information as possible. These poddies are here or designed to give people free information. Like, why not take advantage of it? Listen to as much as you can, and then make your own decision on what's right and wrong, right? But, it's very clear, like Parramatta is a good example of very, very high, like a lot of high density R4 zoned on nearly every corner.
Yeah, 100%.
To be fair, they haven't really built much lately. So at some point, the supply would probably catch up with the demand, and units are quite affordable there. But I still wouldn't be buying in a complex with 400 units. I'd be looking at, the smaller blocks that are rezoned that you could pick up for a bargain at the moment. That's probably where your value proposition is there. So if people are considering, where to buy, when to buy, just have a look at all of the fundamentals of what the property represents, and try to break it down to intrinsic value where you can. What does it cost to replace a 2-bedroom unit? Is it going to cost you, like, if they're going to rebuild that today, probably in the 500 grand mark, right?
Yeah.
To rebuild a basic bare bones unit, put some depreciation down on it, and then look at the land value that you have. And it kind of gives you an idea of what, the unit is actually worth, for instance. So there's still plenty of great buying opportunity in those markets.
Now, we've also done 2 poddies with Sam Gordon, buyer's agent from Australian Property Scout. And the first one was rent vesting versus buying an owner-occupier, what opportunities people there, but also using structures to purchase. What are some of the key takeaways from that first podcast? And then we'll go into our second podcast with Sam shortly.
Yeah, so I had a big golden nugget moment in there myself, because I've always argued an owner-occupier versus the investor. I like both. Because obviously an owner-occupier, if you buy that property, it goes up in value, it's tax-free when you sell it.
100%.
But Sam said it very clearly in that podcast, is like, it's all about the opportunity cost, right? Is that your forever home? And if you know that it's not your forever home, can you outperform that with an investment property, even after tax, that is going to grow a lot faster than your owner-occupier, and you could just rent until you get to your forever home? And it's the opportunity cost about the actual borrowing capacity it affects by having a PPR debt as well. So that was a really key nugget, I think, there, is comparing the PPR debt for the opportunity cost of buying 1, 2, 3 multiple investment properties, which, if structured right, you'd be able to expand that portfolio quite substantially. And you'd do it in a way that you're not afraid, because you can pull levers when you need to. If cash flow starts getting thin, you re-leverage, or you sell a property and you reduce the debt facility and keep some cash. So if you're buying in the right growth markets, which I know Sam does, because I've been dealing with a lot of his clients throughout the years, and they outperform the market substantially. If you're in a PPR market that doesn't have any signs of growth, it's probably better to have a view of maybe reinvesting. But I think you have to do the numbers yourself and see what makes sense for you. And you've actually got to have a really good team around you. Make sure, if you're not a serious buyer and you don't understand all of the elements, get a BA, get someone who you can trust, and make sure you've got a really good BA who understands, obviously, the property economics and how it all works, not just from textbook, but what's actually real and what's on the floor.
On the ground. And there are going to be people out there that are super fortunate that you and I are Sydney siders, so that really hot Sydney growth that was actually kind of a few years ago in the rearview mirror now. But if you're, say, a first time investor and you first time property buyer and you're in Melbourne and you bought 1 or 2 years ago, then you might be cheering, or if you bought Brisbane 5 years ago, you might be cheering because you were fortunate that your owner occupier was in this huge growth market. But if you are in an area, and Sam does put it pretty well, where You look at Darwin, which kind of over 14 years didn't do anything. Perth, which over 20 years didn't do anything. If you're in a market where you say, oh, actually, my PPOR might not do much for several years, it might really stay stagnant for a really long time, then it is an opportunity cost, because there are always going to be, and I hate using the term hotspots because we overuse it, I think, in this industry, but there are going to be postcodes which perform really well, and there are always going to be reasons for it. It could be rezoned. There could be a new train line that's opened up, a new hospital. There could be all these iterations of things that make this postcode that wasn't in demand before now in demand. And on that basis alone, you can outperform had you held on to your PPOR. And it's something that I dwell on a lot. Sam, in that first podcast, also unpacked using structures, which I know in the headlines has been spoken about a lot recently. Can you take us through the kind of fundamentals, the 101s of buying within structures?
Yeah, so I guess there's been a big thing over the last it's been years since it's been happening, but I think a lot of people caught on to it recently with all of the influencers out there and whatever they call it.
Influencer, we'll go with that. Yeah.
But yeah, talking about buying in unlimited borrowing power, buying in structures, right? And basically, as soon as you can get a structure profitable, how you do that is either through selling properties, reducing debt facilities, rents increasing, building granny flats, throwing in commercial property into that structure. And at some point when that structure quarantines itself and it gets down to a $1 profit or higher, all of the leverage that's inside of that is now ignored. And then they set up a new structure and then they try to build that one out again.
Yep.
So, a lot of the major players pulled out of the game. One a long time ago, not even noticed because it didn't hit the media. And then another one pulled out. And then as soon as that second one pulled out, a third one pulled out. And now all of the majors are starting to be very weary out of it. And I guess the common trend moving forward is a lot of these majors or sub-majors, they want to see everything. Doesn't matter what structures you have, they want to see all of the debt facilities, whether it's profitable or not. It's kind of the trend that it's moving towards. That being said also, but there are a lot of non-banks which are still working off the same algorithm that if it's quarantined, that they'll still lend to a new entity and ignore the older entity, right? In order to look at these funders, but the interest rate technically is going to be higher.
Yeah.
So it's a rate for risk. If you're a seasoned investor and you're trying to build out a portfolio, you look at your opportunity cost. If I'm going to lose 1% in interest here, but I'm going to make 20% in growth, I'll take the 20% growth every day of the week.
Yeah.
So it's a very hard conversation at the moment for those who are trying to build out substantial portfolios. The most very common one I'm getting on a week by week basis, they're like, should I buy in a trust or should I buy in my individual name now that all these changes are coming in place? My answer to them on that is, if you don't buy in a trust and you believe you can quarantine that trust to get it profitable someday, then whatever you buy in your individual name will stick with you forever. So you'll never get that borrowing capacity back. You'll have to sell to get it back. Whereas if you buy in a trust today and you're able to then, you might buy multiple properties in there, sell one, reduce the debt, then or put that money into a commercial and a high cash flow yielding asset, all of a sudden you've got that quarantine, you can start again. So if you are going to say trust or no trust, if you are looking to become, I guess, a seasoned investor and build a substantial portfolio, obviously you have to look at that option straight away. But if you are just looking at buying one or two properties here and there, and you're just going with the flow, then just buy in your individual names and get the right accounting advice on either side.
One thing I do want to touch on, because I think for a lot of our listeners, they might just take the advice of their broker and they kind of just get handed a suite of options. They might pick the one with the lowest interest rate, which I know we've discussed at length that, the lowest interest rate isn't always better. It's the policy behind it, which is the best to fit into your portfolio. You mentioned non-banks before. Can you give our listeners a bit of a 101 into non-bank lenders, why they might benefit your portfolio, and sometimes maybe when it doesn't benefit?
Yeah, so I think the key or the biggest key point is the non-banks allowing you to borrow more money, right? So whether it's, you might only have 400 grand with a major, whereas you can go to a non-bank and because of their calculators are built differently, they might give you 700, right? So if you wanted to buy, say, a property in WA, I know WA quite well at the moment. So 400 grand is not going to really get you squat.
Yeah.
Right. But 700 grand will get you a really good asset. That'll get you a house on land, not far from the beach. Whether it's a big house, small house, you can get a house.
Yeah.
Right. So if you look at that as just a big picture, if I bought that 400 grand, what I'm going to get there, I'm probably going to get a 2-bedroom unit, and so for whether that goes up or not, the market's moving in units there at the moment as well. But I'd much rather have that house, especially when the yields aren't too far apart, or the net yield after strata costs and the rest of it. So that's a really key fundamental of non-banks. Other non-bank lenders, for instance, there's low doc lenders. There's private lenders. Just depends how extreme you're going to go. Like a low doc lender, it's technically for self-employed. I think we mentioned on one of those podcasts, accountants are slow. Yeah. And having your slow accountant not getting your tax returns done within a timely period, it's holding you back from getting into the market, 100%, right? 100%. Yeah. So that low doc lender might be who you need for now, with an exit plan to refinance once you've done your tax returns, because you know that your profits are there. There's so many different layers of it. Depends on how far you want to push the boundary. But if you are going for a higher rate of interest, you're doing it only for a temporary time, ideally, is what you're thinking anyway. Yeah. Until you can consolidate it back or to a good lender.
And this is where having a good broker comes in, because they would have non-banks, they would have private lenders on their panel. It's called a panel, isn't it?
Yeah, correct.
Your panel, and depending on your risk appetite, and depending on how aggressive you want to be with your investing, they can present these as options. But also adds that layer of flexibility. Maybe aggression's not the right word, Hung, but that layer of flexibility that if you are a small business and you want to jump in, that they are a little bit more flexible than the rigidity of a bank. And the trade-off is a higher interest rate. But when it comes back down to that opportunity cost of being in a super high growth suburb, realistically a few percent. What's the difference in percent?
Look, if we're going, so funny enough, with some of the non-banks, sometimes their rates are pretty much the same, right? And they just got a more aggressive calculator, but people just aren't comfortable with it, right? Yeah, for some weird, strange reason. Yeah. I get why, because during the GFC there were certain non-banks who fell over and got absorbed by other lenders. So you can see the history behind it. 100%. But so there's, at the end of the day, but they've got a mortgage facility and they're committed to that. They can't just jack the rates by 3 or 4% on you, right? Yeah. But there can be movements outside of cycle within reason, because obviously the government's looking at it. But yeah, I guess it's just a tool, really, to get you to that next stage. And I think a lot of people are just, they don't know what they don't know, and I think they're just a bit shy when they haven't experienced it yet. But yeah, you do need to have as much, I guess, ammunition in your artillery ready to go, right? So if your broker only deals with majors, they don't really know how to build a portfolio out, it's probably slowing you down from getting to the next level.
100%. Now, with Sam as well, we discussed when to buy commercial and when it's the right time to move into the commercial market. I know a lot of people are talking about commercial real estate at the moment. When should our listeners consider making that leap?
Yeah, so I think with that episode, a quick summary was that Sam and I both agreed that a lot of people should start with a resi portfolio to start off with, to get that growth, get the capital gains as fast as they can. And it depends on what their end goals are. Commercial is it should be a very easy transaction in the sense that everything is taken care of by your tenant. It should just rent out with a net yield, because the tenant pays pretty much most of the costs, or if not all of it, depending on what your agreement is. So when you're looking for that cash flow, not to mention that there will be growth, but maybe not as substantial as what the resi market does because of the emotional factors, the supply and demand, much more easy to measure. Whereas the commercial properties, the yields will start at a certain amount and they'll keep increasing by CPI or whatever the raises year on year and what you negotiate. So ideally, a lot of people move in. It just depends when they want to move into it and what their portfolio looks like. Some people slip in a commercial in between a few resis just to get the cash flow to balance out. They might sell a property, use the cash to put one in there, and then quarantine that trust, for instance. That's something that some people do.
Yeah.
So there's no real fixed and fast form about when, but I think the common sense, I guess the common theme was that, you should build as much wealth as you can for the resi market, ideally. And then you can tip some of that or sell a few properties and move that into commercial. Or at the end of the journey, you might just have a stack of cash flow play properties, which will continue to grow because they're good properties, but also generate your passive income when you want to stop working. And how soon or how late that is, it really depends on you and on your goals.
Now, with that, there were actually a few interesting takeaways that I remember, which is the doing your due diligence on tenants, because what we were talking about was, you go into a commercial asset and you're like, oh, the yield is so good on this, we're going to make a bank. And then suddenly you buy it, and then, 1-2 months later, it was a fake.
Yeah, the Fugazi leases.
Tenant, and they did a runner because it was someone's cousin that just set up an ABN, and they inflated it to make it look like it was a really high yielding asset when in reality it wasn't. And then suddenly you're in panic mode. You're dropping the rents. You're getting long-term clients, long-term renters, and then suddenly the value of your commercial real estate asset drops as well because you've got this tenant in there that's just not paying as much because you had to panic get someone in, and that's a common thing apparently.
Yeah, or it's more common than you think. Because especially when you're looking up for online, it all looks good on paper, and you're seeing these massive 6-7%, 8% yields or whatever you're seeing. But I think you have to dig a bit deeper and figure it all out. So if it was anyone out there who's trying to jump into commercial, who've never done it before, I don't necessarily recommend doing it unless you really understand and learn everything about it. Try to rely on a good buyer's agent.
Buyer's agent, because the three of us with that last podcast, I think it was actually our last podcast of the year, was it?
Yeah.
With Sam talking commercial. There are not to drag people through the mud, but there were a few buyer's agents which you both saw, that you both had deals. You had that example where I think someone bought 2 commercial assets because they got inheritance.
Yeah.
Sam had someone come knocking on his door because they had a commercial asset which did the same thing. And they were all three of them, I think, sourced by BAs, but it was all kind of substances.
Yeah.
It was BS.
They all became vacant, all of these properties. And that one client I dealt with, is in a lot of trouble. Vacant, can't sell, can't get rent in, not earning enough income. So heaps of trouble there, eventually selling for a loss to then just make repayments for the other one, basically lost the inheritance in the transaction. So it's it can be a very tough pill to swallow if it goes south. So that's, I think I was speaking to one of the other buyers agents in the commercial space, and they were telling me about the touch points or the data, that they need to do a purchase, or the data points that they put in. And it was like, he reckons about 20 times more than what they do on a resi.
Yeah.
So,
yeah, which is good. And one of the bits of advice which you gave to that, which really resonated with me, to make sure that that level of safety, that you could say hand on heart that this is a good asset to buy. And I think you gave the example of like a fish and chip shop, like say you got a fish and chip shop there, go and buy it. Is it good? Is there a line outside the door, or is it a Friday night where people should be lining up and there's not a single person in there? Make sure you do your due diligence on whatever asset you're buying. So the second you buy it doesn't just shut up shop.
No, mate, it's as simple as doing the drive-through and just driving past and at the call times to see if that business is actually thriving. Look up the business. ChatGPT gives you a lot of answers nowadays. Not to rely on that, but I'm saying just get out there, see the property, see what they're actually doing, understand the business that's actually renting it, because it all looks good on paper, but people just like, commercial is different to resi. Resi, you can have Joe Blow, anyone rent your property, and then you can just, the rental market's strong.
100%.
But in the commercial space, once that property is vacant, you're going to have to spend money maybe to helping them refit it, depending on what they want to negotiate with you. If it's if it's a tin shed, then it's easy. But I mean, like if you're doing some sort of retail, the new tenants want to come in, they need certain things, they're going to negotiate with you. So, you've got to have a bit of capital behind you when you're getting into commercial, not just for the sake of obviously having buffers if there was no rent, but also if you do need to make improvements to get new tenants in also, otherwise it's just sitting vacant and you're paying a debt facility that's just chewing your capital down. So it's really, really core to, like, I think if you are not a seasoned commercial buyer, to get good advice, or even find a way to sign up a BA, or do the research before you get there.
Now, on that, the art of selling, take us away.
Oh, mate, that's always a tricky one. So we talk about it all the time, and selling, I think, is one of those things that Sam brought up in the podcast, and we talked about it quite frequently. Is what Sam does in the selling piece is they're looking at all of the where the data set presents at any given time, and when it is the right time to sell, you're only selling, but because it's giving you more opportunity.
Yes.
Right?
Yep.
If the market's still growing there and you sell, but you don't redeploy that capital elsewhere, then it's useless. What are you selling for? Just let it sit, because ideally the growth will outperform the loss of rent in those markets. But if it isn't, and you're actually losing rent and the market's not growing, then that's obviously a double diesel that's going downwards, right? So the art of selling is it's not an easy thing. You need to understand what the next step is before you sell, I guess, is the biggest core learnings around that. So for instance, I sold one a while back, and that allowed me to buy 4 properties because the way I structured the sale from the one. But it pushed me out to non-bank lenders and things like that. But those 4 properties that I managed to purchase off the one sale, that probably went up another 200 grand since I've sold it, right?
Yep.
But I'm not angry, because the 4 properties that I bought, it went up over $1.7 million.
Of course.
So it's the art of selling is a hard one. You need a really good team. I always bring it back to people who understand building portfolios, not just going, hey, I'm selling, all right, let's send the discharge form, let's just clear the debt. No, there could be other ways. You could port that mortgage, keep the cash for multiple deposits, use that cash then to go to a more aggressive funder who will let us borrow some more money. And then you might buy an extra property or 2 extra properties, which, if you're looking at, say, money that's being leveraged, if you have one property, say at $1 million and it grows 10%, you're going to get 100, that's 100 grand growth, right? Yeah. But you spread that amongst 3 properties at $1 million, you have 3 million and you get 10%, that's 300 grand. So it really starts amplifying, right? You take that to a $20 million portfolio and you make 10%, that's $2 million you made this year. So when you look at that, you might be leveraged to the bone, but you're making $2 million year on year at 10%. If you outperform at 20%, we're talking $4 million. So
100%.
Once you start selling off assets and timing your sell, especially with the tax algorithm, you don't want to sell them all out at the same time, but make sure you get the advice and really have a plan ahead of when you do sell, what your next move is going to look like.
And that's where, Sam does it really well, which is, not looking at it emotionally. This is a business. If you have something in your business that isn't working, you have to get rid of it. And if you have the ability, as you pointed out, to redeploy that into something that does work, it is very important to do it. I'm sure you would see it all the time in the broking space of people that are emotionally buying or emotionally selling, and it's not necessarily the right time to do it. How do you view that emotion, and how can investors navigate the emotion of it? Because that's probably one of the hardest things about the investing world, is where your heart and your mind, they're not speaking the same language, but also you start second guessing yourself. How do you speak to your clients about that?
Oh yeah, so I use my own live examples. So like I sold a property which was my worst performer in my portfolio, and that allowed me to obviously extend out. But leading to that, I held on to it for so long, and holding on to that limited me on multiple factors. One was borrowing capacity. The second one was the fact that that property wasn't growing. It's actually costing me money to hold it every year, like a fair bit of money. So they both didn't make sense. I was too stubborn to sell for a loss. So had I just taken the loss, it would have been millions of dollars difference very early on in the journey, because the first few properties need to be right. Because if they're not growing, they're gonna do 2 things to you. They're gonna shift your mindset against property, because you got that that negative connotation built into your brain, and it's going to slow you down from buying good properties, which will allow you to get the growth that you need in order to keep growing. So I think, it's really, really important to actually talk to someone who can understand where the next moves could be. And really somebody who's got skin in the game, who's done it, made the mistakes. So when we do have clients, I'd share with them that. And then when you are looking at the property to sell, you've got to be very, very, I guess, diligent about, not just the next move, but is there potential growth in this property? So, so people are selling emotionally. They're scared of interest rate hikes. They're, the property's had a blown, something blew up in there and now we've lost $5,000. There's things that trigger people and then they sell at the wrong time. Yeah. Get as much information as you can. Even you can just Google or ChatGPT. Keep going back to this, but you can just Google certain things and then obviously verify it through your own sources. But look at the migration figures. Look at the construction figures. If you look at an area where there's no construction, I'll use Perth as an example. I think it's under 20,000 dwellings being constructed. I think migration's at like 60,000 or something like that. You've really got a positive 40,000. So where are 40,000 homes going to come from when they're all full? 100%. And the rental market's at like 1% vacancy and below. So you just look at data like that and go, well, is this really the time to sell? And then they just announced 25 billion or something in infrastructure projects, which means more people flying in to do more work, which means not just the migration figures.
It means tradies are off the tools in building houses and building, and it's good, build highways, build trains, build metros, and that's a good thing, but it means there's less tools being picked up for those new houses, for those 60,000 people that are coming in.
Yeah, no, exactly.
And it's that simple. And on that note, it's actually probably the best segue that we could have. We had a podcast with Steve Maroon, and I loved this podcast. It was so good because at the heart of it, I think every Aussie thinks that they're a tradie. Every Aussie thinks that they can do a renovation. And obviously he works in large construction. I'm going to start with this. Every Aussie thinks they can be a developer. But it's actually not as simple as people make it out. So what are some of the top tips? And you've worked a fair bit in the development area. What are some of the top tips that people can take from this field?
Yeah, so I think everyone thinks property development is simple. And I think the majority of people who want to be developers or very keen is because they see obviously the big shiny numbers and the truth is the money is made in a development deal, like Steve said in the podcast. It's made when you buy the property. You're seeing intrinsic value that no one else sees, right? You're seeing an opportunity to convert something that the market would want with a good profit margin inside of it. If everybody could see it, then everyone would be doing it. But even as much as you can see it, once it comes to actually getting the work done, Steve and I go through how hard and how complex it is sometimes. And you have to have a pretty good bankroll because you are going to run into problems every day of the week. If the council doesn't sign off for you, like our particular deal, we were about to lose 6 more months of interest, which would have cost us land tax interest. I estimated close to $400,000 just by that one signature if Steve wasn't persistent enough to be there all day to try and get this deal done, because it was logical in our eyes, but to get through the red tape was going to be impossible. Simple things like we had to go around to the neighbor's house and beg and plead them to withdraw their I guess they put a few things in there to not allow a DA to go through. Just had to make friends and do the human thing, explain to them what we're adding value to your house. So
and that's the thing. It's the red tape. It's something that's so simple. That example where I think the general manager of that council, I think it was the GM, was going on holiday, and it was the day before he was going on holiday. And if you didn't get the signature at that one point, it was going to have that domino effect of all these things going wrong, which would have led to your $400,000 loss, or not loss, but cost to get it done, which would have been a loss at the end.
Or I guess it hurts more at that cost level because it's not leverage money. This is our money we have to put in now. So previous to that, we're having the lenders bankroll us to a certain point,
and now this is what.
But now this is coming out of my own money to put that in. Right, that's where it hurts the most, and you're sitting there in limbo. So unable to then sell lots off to bring cash back in to then fix up the deal. I guess the key points around developing is, if you want to do it, make it your everything. It has there's no half-ass part-time. It has to be everything.
So it's not as simple as, okay, this house could be a knockdown rebuild. Mr. Builder, can you do this? Yes. okay, cool, I'll speak to you in 18 months.
Yeah, no, there's some simple deals like building duplexes and things like that. But when you want to start getting to land subdivisions, building townhouses, building units, it needs all of your energy. And a lot of people, where I see them fail the most is you got three guys, one guy's an architect, one guy works in construction, one guy works in some other field, and they all got full-time jobs. And they decide to buy a big site together. Because they believe the expertise are going to be there, but it's all about the time and energy too. And sometimes you spend all of this time and energy and then you only make a builder's margin, for instance, inside the whole deal, and which is a very common trend. Construction is very expensive today. There has to be a lot of fat in it to do it. So it's not everyone's game, but I think that the convo with Steve was highlighting that it is fruitful, extremely hard, massive buffers required, and the most common thing I see is people without the buffers getting in, and that's when they blow a gasket.
100%. It reminds me of going back to Sam. Sam and I had a conversation about renos, and obviously, renos aren't anywhere near as complex as these large construction efforts, but similar trap though, where people think, to your point about construction costs, construction costs have gone up, 40% since COVID? Like that's really substantial. With the reno side, people being too optimistic about timings where, he's got examples of clients where he's had where, something's going to take us 1 or 2 months and then it ends up being 6 months because they're trying to do it after work because, you're a tradie and you can do a fair chunk of it by yourself, but you're doing it in your own time. You're doing it at nighttime, on the weekends. There's going to be weekends where you're sick, where you're too tired, whether you're with kids or whatever. And then it blows out to 6 months where you're not, say, tenanting the place. And these are substantial costs which you don't necessarily factor in when you're overconfident. So if someone is interested in getting into the construction industry, in those larger kind of efforts like you highlighted, where can they start?
Yeah, so I think there's a lot of different, I guess, podcasts out there, and I won't name names at the moment, but there's also like group sessions, and there's a lot of different groups out there who can teach you a fair bit about it. But I would say, obviously, going on the podcast, try to find who's doing it well, with obviously live cases and past cases. So skin in the game is really important, and kind of don't just take their word for it. Ask them for proof of what they've actually done, and it actually shows the numbers, so you can learn off them. So there's a lot of different networks out there doing it. That's where you probably start, or you just you have to go. Don't do it my way. I dive deep and threw money everywhere into different developments and lost a lot of money over the span of my first 5 or 6 years until I figured out my own Da Vinci Code around it. But at the end of the day, don't just look at the numbers. I think it's a matter of what product are you producing. So, we have a housing shortage crisis at the moment. If you are delivering, the government's going to support you in every possible way because they want more houses faster. They don't want this crisis to keep going.
Now, pulling this all together, first-time buyers, for those of us who are in that space or, they've got friends, brothers, kids, cousins that are first-time buyers, where can they start?
Yeah, so I just did a potty on first buyers, but look at all the schemes is probably where you got to start with, and see if the schemes match up with your needs. Whether you can live in a property, say 4, 5, 600 grand or whatever it is, in the area that you want to live in. Like, are you willing to sacrifice to live somewhere else? That's something that they've got to think about. Is there ways to save faster? Could you buy property now? If, people don't know that the guarantees are available. Parents can give term deposits as guarantees. They can give properties as collateral. You never even know. So those conversations need to be had, right? I've had clients who didn't know that their parents would give them a guarantee. And the next thing you know, they don't want to leave where they're renting. And the parents give them a guarantee to borrow the whole 100% plus costs, get them into a good investment property. And it changes their life around very, very quickly. So I think for first home buyers, look at all your options. Go to a good broker, somebody who understands all the elements, but also load your questions up with them also. What you'll want to ask before you get to them.
Absolutely. There have also been some pretty big lending changes. I know you highlighted that a little bit earlier before. We also had the debt to income caps, the 6 by debt to income cap. A lot of people were talking about it at the end of last year. It seems to have been kind of not forgotten, but maybe it wasn't as big as we all thought.
Yeah, so the 6, for those who understand what it means, but the 6 times DTI rule that they're only allowing lenders to carry, I think it's 20% of their book now of people who have above 6 times their income. So simple maths, 100 grand income, times that by 6. You can borrow 600 grand as a cap. Can you go above it? Yes. But keep in mind the banks are going to be a bit more cautious around you because they can only allow 20% of their business to be that.
Yeah.
But to be fair, most lenders, based on their calculator, will never get you past 6 anyway. So, and currently the non-banks aren't governed by it, so you can push the boundaries a bit higher, right? So this is a deposit-taking institution rule. But I've always used the rule of thumb. If you want to calculate your borrowing capacity, put your income, put your rent, shade that by 80%, and then times it by 6. And it kind of gives you a rough idea of what your main bank lending is. And you'll be surprised how low it is. Actually,
that's what I'm wondering. I'm like, hang on, how does that? Yeah, and so it's not as ground earth shattering as we thought originally.
No, not at all. I think the biggest in the scope of lending is the trust lending and the banks pulling back. But I always say when one door closes, another door opens, and I'm beginning a lot of these non-banks starting to say, "Oh yeah, no, we do that." You know, so. I don't know where it will lead, but the opportunities are still there. I think people who are trying to build out portfolios, they really need to understand what their options are, and whether they need to be buying in structures or not. They need to speak to the accountant also to look at what land tax looks like. Is there a different trust they could use? Also, in New South Wales, there's 2 different trusts, with the unit trust and discretionary trust, which will depict how much land tax you'll pay. In one trust, you get no threshold. In the other one, you get the massive threshold. So it can be substantial yearly, $30,000, $40,000 difference a year in just taxes that need to be paid by getting your entity wrong.
Yeah, 100%. Now, for seasoned investors, where should they be looking at now?
Oh, the seasoned investors, I think what happens with a lot of seasoned investors, they start looking at shiny objects again because they've made massive amounts of wealth, right? I think what they need to do is still just bring it back to the fundamentals. Some of the most successful seasoned investors just keep buying the same thing because it works, right? Those sub 700 grand houses that are, built with double brick, where the house would cost you 600 grand to replace and the land's worth 400 grand. It seems to be the easiest form of having full control and making money. Comparing that to going through all the work of developing, no sleep at night, doing after hours work, having to rock up at council, having to deal with problems. Somebody drops asbestos on your site.
Yeah.
A million different things could go wrong, right? And your stress level and how much you're willing to, I guess, take on, is it worth it? So unless you think this is going to be your forever career, you're going to go develop for the rest of your life. Be very careful of jumping in development. But so seasoned investors, so many different opportunities there. Still buying with intrinsic value seems to be a good case. Commercial, the yields are good. So there are a lot of guys I'm starting to see shift into that space, because they might be transitioning their portfolio to build cash flow now.
Yeah.
But that might not be suitable for everyone.
Yep. And selling as an option, should people consider it?
I think with selling, as we said before, really you need a good team around you to understand exactly why you're selling. A creative broker is very important in this piece because it's all about the opportunity.
Yeah.
So if you're looking at it just purely on selling because you're trying to outperform in 12 months, 24 months, I reckon in 30, this is what I hear a lot. I think in about 30 months, the market will be better.
Yeah.
Justify it.
You cannot predict that far into the future.
Justify it. Why?
Yeah.
So tell me, why is it going to be better? What's changing?
Yeah.
And they're like, oh, nothing's changing. Interest rates might go up. And okay, well, where's your opportunity moving forward, right? I think the biggest thing is people just deciding to sell, like you said, emotionally, or without really understanding what the market's doing.
Yeah.
So once you get a grasp of that, your decision making is easier. Once you get a grasp of your next move, makes it much more easier.
It's it's like a sports team, but easier. It's a sports team, but easier. You've got an asset, or you've got a player that just ain't working. You can trade them in, sell it, get the equity, and you can trade it in for a player that is going to work. By working with a good broker, by working with a good buyer's agent, you can move into those growth markets. At the end of the day, it is opportunity cost. But as you said, the emotion is the hard part. Now, Hung, I think this is probably the fun part of the show. Now, are we allowed to say their names? Maybe first names?
Yeah, maybe first name.
We'll do
I think,
first names because we've got, I think, 3 or so questions, and I think they're pretty common questions. And some of them we've actually kind of touched on already a little bit throughout the podcast from our listeners, and for our listeners as well. If you do have any questions, get in contact with myself or Hung. Hung's active over the socials, so hit him up, hit me up, Liam Garman on socials, or send me an email. Starting off with Cam, what is the entry level for commercial properties and how much does it cost to get in them?
Okay, so I think we answered it in the commercial potty in the sense, not the entry level, but I spoke to a few different buyers agents before this because I saw that question pop up, and it's a hard one. I was told by one buyer's agent that they could get some good retail at 500 grand, right? I'm not sure if that's my cup of tea, to be honest. And then I spoke to other people, and they were saying, we want a budget of at least $1 million.
Yeah.
And then I spoke to other people. They go, you want to see 3 million minimum?
3.
That's
a big difference.
That's for freehold. More, if it was me personally, I would like to see 3 million, just because of the upside of potential development, the upside of all being able to maybe build the property out further or get more leases in to increase the capital value.
Yeah.
You want to see some opportunity, right? And especially having a freehold, you need at least 3 to 5 to get a nice freehold. If we're looking at properties, like somebody said, at 500 grand for commercial, I would say let's get into more resi first.
Yeah.
If you're buying at that level.
I suppose if you're at that level as well, where if you're, as bad as this sounds, but if you're kind of counting each dollar at the 500 grand mark, then you really should be building that base a little bit more.
Yeah, 100%. And the 1 mil mark actually represents a pretty good opportunity especially for those. I'm noticing the yield play around that 1 mil mark is quite attractive from what I've been seeing come across my desk, especially for those who might have sold a couple of properties in a trust, for instance, and they wanted to shift that same trust for a property in a different state with a commercial property to then now produce a yield to cover the repayments of the other 2 properties or reduce the debt facilities. That's what I've been seeing a common trend around. That 1 mil, that 1 to 1.5 mark, I've been seeing some really, really good deals happen.
Yeah.
No.
Now from Sarah, would you purchase an investment for your first property or an owner occupier if your budget is 700K?
Oof.
I suppose that one's, I'll take the first bite of the cherry with that, but I think that one's, there's so many variables, what part of the city are you in? So for example, if we go back to what we were talking before about, say, the Parramatta unit market, if you're in Sydney, Sarah, realistically, you're probably not going to get much for 700K. It is a unit in the West, but in areas where there's also an oversupply of units, you're realistically, you're not going to get a unit for 700K in an area where you're likely to see capital growth with a lack of supply coming aboard because they're already above that 700K mark. In a lot of areas of Sydney, well above that 700K mark, especially around the inner west as well. Not financial advice, but would you potentially risk going into your Parramatta's, like we said before, or your Liverpools, where it kind of is a dime a dozen, and you risk not moving for 10 years. But again, it depends where you live. If you'd be cheering if you were living in Melbourne and you bought in Frankston North last year, right? Or like in 2024 even, because you'd get a pretty Gucci place for 700K, and you're probably cheering at the moment. There's a lot of variables.
Yeah, no, 100%. I think at a very high level, quick answers to that is, if you're looking at the first home buyer schemes, because you've got a limited deposit. So to buy an investment property, you're going to need a larger deposit, right? 12% plus stamp duty, general gist, or you can go 5%, like plus pay to LMI, get to the 95% lend, but the interest rate's really high. So the stamp duty waivers as well, so there's just to get in. How do you know if you're in a growth market or not? It's a hard one. Good property is property which represents good intrinsic value or future value as such. And for me, if I was in those shoes, and I don't take this as advice, but if I could move into a growth market and continue my job, if I was a PAYG or self-employed, working off a laptop, I would consider moving
as an owner occupier.
Yeah, as an owner occupier. If that's all I could afford, rather than buying an investment. then yeah, why not? Right.
I mean, you'd still get some pretty good places in the eastern suburbs of Perth for that.
Oh, mate,
you know,
Perth's got plenty.
Yeah.
Mate, Melbourne's still
Melbourne.
sub 700. You can still get into places like Hooper's Crossing around there, Point Cook. You can find houses that sub 700 grand mark.
You find, I don't know, probably full houses, but townhouses in the Moreton Bay region, you know,
Oh yeah, no, in Brizzy as well. Yeah, so
Yeah.
you'd get, the townies are flying at the moment, but so very competitive market there. But yeah, look, there's good buying still at that sub 700. It is a tough price point. I'm not gonna lie, but if you can get it, I guess as an owner occupier, great in a growth market. If you can afford to be an investor and you don't want to move out of the area you're in, because you don't want, if you, let's say for argument's sake, you're in Sydney and you're living, you're paying $650 a week rent, and you're living in a half decent suburb, and all of a sudden to get to an owner occupier 700 grand in Sydney, you're now moving like completely out of that suburb.
100%.
You're moving from one place to another, and your cost now or repayments are up to the $1,000 mark or whatever it is. Is that going to crucify your lifestyle? Is it going to allow you to do anything else besides its own occupier? So maybe investment's more suitable and saving a bit more money to get to a good market.
Which opens up a new question. Yeah, it has to be manageable. Everything you do has to be manageable. There's no point buying for the sake of buying, and then you can't commute for an hour and a half a day because you bought, it doesn't have to be in Sydney, but you bought just somewhere on the fringes and it takes you ages because there's no train line and you're on the bus for an hour and a half, and you end up selling at a loss or at what you bought, but then you've got the stamp duty on the way in potentially if it's maybe above your stamp duty concessions, if it's slightly above it. And this isn't just for the 700K mark. This is just general life advice, I guess. It has to be manageable because you don't want to end up after a year or two being burnt out and having to sell anyway.
Yeah, 100%.
From Anonymous, with all the trust lending changes, would you still elect to purchase in a trust? This is a pretty big topic, but we touched on it a little bit before.
Yeah, we did before. I think, just as a key point, if you are buying in a trust and your plan is to build a very substantial portfolio, your options are either trust or no trust. And as I said before, if you go no trust, then there's no way that you're ever going to quarantine those debt facilities. So you're pretty much going to load yourself up with debt personally, rather than trying to build an entity out to allow it to, maybe throw some commercial, maybe pay down some debt to get it to a profitable level so you can then keep expanding that portfolio. So it's really up to you, but you need to get the advice and just have a bit of a game plan in the future.
Yeah. Now, for this one, I never actually asked this person who sent me an email whether I can
let's keep it as
example.
I think.
So we'll keep it as anonymous. We have a listener who's trying to build generational wealth through property, but he feels like he's navigating it alone, seen a few BAs, said it felt transactional. He hasn't really had that guidance. He's got quite a large property portfolio in the high millions, less than 10, 44% LVR, 700K cash in an offset account. He works in an industry where he's kind of capped off. You might get 1-2% pay rises a year. So having a big growth in his pay packet, it's off the cards. He doesn't really know, where to move next. What would a really sophisticated investor do now? And where's his next move? And I think, look, to start off, I think he's done a pretty fantastic job to have 700K in an offset. Pretty good.
Yeah.
He's got quite a decent portfolio, despite 44% LVR. It's still quite a lot of equity sitting there.
Yeah, he's probably sitting on close to about 4 mil net there, which translates to, I don't know which one's the PPOR or the rest of it, but I think with that level of net wealth at a decent age, it depends on what your goals are. Like, do you like your job? Do you want to keep working? Are you trying to replace this with income now, right? And if you are, then do you have to still pay taxes?
So is this one of those consolidation times that we might start considering that?
It could be, yeah. It just depends on how long his work cycle is going to be from here moving forward. I think from what the mention is there is that he can't get any more loans because he's spoken to multiple brokers. So I don't know if it's the way that they've structured it in a sense, because he's mentioned that he's got a property in trust and the rest of it is in individual name, but there could be some opportunities here where they could if they're looking at the art of selling, which we always revert back to, what can and what can't we sell? What's going to keep growing, because that's going to grow that 4 mil asset pool a lot higher. Do you want income now, or do you want to leave your job? Like when are you going to do this? Because if it's a whole resi portfolio, even at the 44% LVR, you'll be surprised. You're actually not making any cash flow out of it, right?
Yeah.
Very, very minimal, I would say, off the back end of that. So yeah, it's not a really easy, there's obviously no fix and fast for anyone, but I think it's all about goals. What you actually want and where you want to end up in the next few years, or when do you want to retire. But that's always a sliding scale too, right? I used to say I want to retire at 40, and I'm almost 40. And I'm like, I love my job. I don't ever want to retire now. But I just changed the way that I work, right? So I think it's, there's no fixed answer, but I think depending on the goals, you'd have to look at the art of selling, potentially looking at commercial property for yield if you are looking to replace that income. And obviously looking at the taxes and the structures that they're all in to make sure that it all fits. So getting that whole team together to make this happen.
So it might be this is kind of maybe a broke, because he did mention that he hasn't felt he necessarily got the guidance from a BA. Maybe given the size and scale of this, maybe it's actually more of a broker thing to
I think it's a broker thing
first.
for sure, because you need to know what selling and then what it's going to enable.
What the other possibilities.
So what are the possibilities of enabling this portfolio to go further? And I think that's something that you're just lost if you went to 4 brokers, no one knows, right? It's not your typical broker who's going to know how to kind of unwind this. But I think you're going to need someone who really knows their stuff.
This is going to take, maybe it's at a scale where you do need someone to go through kind of line by line, to go through your portfolio and give that tailored advice, which a BA is not only do they not do, but also maybe not the right person to be doing it at the end of the day.
Look, advice is a weird space, to be fair. Like, people are giving advice based on signing a piece of paper. It's like that goes through compliance to now. I think true advice, or it's not really giving people advice, is giving them options, really, right? So if we can show an option, if you sold this, pay down this debt, now we've got borrowing capacity again, you could then expand that to portfolios, or you've got enough cash to then dump that into a lease stock into a commercial property where there's no requirement for servicing. It's just purely the rent. So that now might produce your net passive income, because we're getting a 6% rate on leveraged money. So we're all of a sudden we're generating a passive income. Might be only 40 grand a year, but inflation, if you're going to retire in 10 years, that's going to keep going up, right? The debt facility might stay the same. So we can almost forecast things like that.
Absolutely. Now, on that note, I think that is all we have time for. If you do want to listen to some of those other podcasts that we mentioned today, we'll put those in the show notes. So go back. Obviously, we had Tuan, Sam Gordon, 2 of them unpacking commercial property and different structures, rentvesting. Steve Maroon, who went all into the world of construction. And of course, our podcast with Hung. But how can people best reach out to yourself? You're pretty active on socials now.
Easiest way is to just add us on Instagram and send us a message. We'll reply to every single message. So I hope people get some value out of the potty so far. Thought we'd do just a quick wrap up to start the year, but super excited about next month.
Watch this space. We're not soft. Are we going to
soft launch? No, we're soft launching. We're signed on.
Okay.
We're signed on. So we got Mark Burris coming on next month. So mega episode there. If you do have any, questions for Mark, Liam and I are going to pencil a few out and
100%.
See what his team will allow us to talk about. But it's going to be a great little session. I hope we can get at least an hour of his time, which will be amazing. But if you do have any questions for Mark Burris, do reach out on my socials. It's Strategic Brokers on Instagram is the easiest way. Send us a message and we'll try to see what we can ask.
We'll try and get as many of them in as possible. That is all we have time for today on the How I Met My Broker podcast. I was Hung Chuy, Director of Strategic Brokers, and Liam Garman, co-hosts of this podcast. Do reach out if you have any questions. But until next month, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.